Coming up on Business Incorporated, Egypt's annual urban consumer inflation rose 15% year-on-year in September. And Kenya and Rwanda eye the West African market, with Ghana becoming the next partner. Plus, oil prices take a breather, easing off 5-week highs. Hello and welcome to the program. I'm Ladi Williams. First off now, let's take a look at how your money is performing at intraday. Starting in Africa there, we see the NGX there closed Friday in a positive, up 0.19%. We saw some bargain hunting with stocks like MTN Nigeria, FTN Cocoa Processors, boosting the market there. And South Africa, it's down 0.72% at intraday. We'll flip over to other markets we track in Africa. Now we see Egypt is open today and is trading 0.05% down at intraday at 9,945 points. While Kenya closed Friday with a big move up 2.18%, closed at 126.32 points. Let's move over now to the Middle Eastern markets. Now we see Abu Dhabi there, that's down 0.53%. They're open today, even though we have a public holiday right here in Nigeria. They're open down 0.53%, and the Dubai index there, 3,345 points. That's also down 0.82%. Let's flip over to Saudi Arabia and Qatar there. It's all negative across board there, with Qatar closing, trading at 12,913 points, down 0.53%. Saudi Arabia down 0.47%. We'll get more on the close by tomorrow. Let's look at Europe now. We see overnight stays in Germany surpass pre-pandemic levels in August for the first time. It's just the latest good news for Europe's tourism industry, which has been eager to leave the struggles of the past 2+ years behind. Let's bring in Stephen Beardsley now with DW, joining us right there from Berlin. Great to have you. So is tourism in Europe finally back to pre-pandemic levels?
It definitely appears that way, according to recent measures. One thing that we saw in recent numbers released by the EU is that the number of overnight bookings made via online portals for the first half of this year actually eclipsed the same number from 2019, that is before the pandemic. So think of bookings made through Airbnb, through Booking.com for hotels, for example. So that is significant. We're seeing that the traditional regions that are popular amongst tourists are again popular, whether it's the Alpine region, whether it's the Mediterranean area. So traditional destinations in France, Spain, and Italy all doing well from what we can tell. In Germany, this news from today is also a sign for hope. In August 2022, 58 million plus overnights. That's 1 million more than in the same month in 2019, again before the pandemic, and that is a first for the country. So that's positive news there. Now, one area that does seem to be lagging behind is international air travel, and that's globally. According to the International Air Transport Association, right now, international air travel for August 2022 is actually at about 2/3 of its level from August 2019. So from that, we can glean that a lot of what we're seeing right now in Europe is probably domestic travelers as well as inter-EU travel. And that's not just tourism, we should mention, but also, of course, business travel back on the rise.
Right, it'd be great to see hospitality back up, but what challenges lie ahead for the hospitality industry?
Well, one challenge that we've been seeing throughout this summer is labor shortages. Now, if you look at the airports, that's probably been where it's been most evident, actually, for much of the summer, for those who have been flying in and have lost their baggage because there aren't enough baggage handlers. There aren't enough security staff in many major airports like Heathrow, like airports here in Berlin as well. And so that's one area where you see just how tight the labor market is. That has hit the hospitality sector quite hard. We've seen that many proprietors of restaurants, hotels, bars, they've actually had to fill in for shifts themselves. They've had to recruit family members, and they've had to see if they can extend employees into more shifts. So it's been very difficult for them, and there's no signs that it might be getting better in the near term as that labor market remains tight. All evidence suggests that people have gone to other sectors with that tight labor market, into retail, for example, where they might get better pay, they might have better conditions compared to restaurant work. That is one concern. Two other concerns. COVID looms large as we enter colder temperatures in the winter. Recent years have seen heavy restrictions on the hospitality industry, from hotels to restaurants to bars. Not so much last year as the year before, so there is reason to hope that whatever restrictions come into place won't be as difficult as 2020. But really the big wild card this year is going to be energy prices. Businesses of all types are really facing a setback in terms of the higher energy prices they're going to pay, especially in Germany, which was heavily dependent on imports of Russian gas. They've since fallen away in recent months, and that means that that energy providers have had to rely on spot market costs, which are much, much higher. That feeds into electricity costs in turn. That means that the overall picture for energy price has gone up across Germany, and that feeds into product costs, to food costs as well, in every other term of inflation that we can see. So that is going to be a concern. We know that some hotel branches in different parts of Germany have already asked for government help in the months ahead, and we've also heard rumors that some hotels may consider just closing for the winter to ride out that difficult period and then reopen in the spring.
Yes, relying on spot prices is not easy, but how are the markets looking in Europe today?
Well, European markets appeared to be dampened, and at the outset they were down. They were losing ground. Two reasons for that. One is the rocket attacks happening across Ukrainian cities right now have dampened a lot of sentiment across markets as a reminder of the war and the obvious message that it's not over and that things can get worse. That's only added to the negative sentiment over the past days due to concerns over growth, or lack of growth, I should say, across Europe. The specter of recession looms even larger, and the likelihood that central banks will continue to raise interest rates, which will eat into business profits. So today, from the outset, we've seen the biggest indices, the FTSE 100, DAX, CAC 40 in Paris, all of those down on those two sentiment killers, frankly.
Right. Well, we'll keep watching. We know getting data later on this week to see how the markets actually perform. Thanks so much, Stephen Bersey, right there in Berlin. Let's move on now to Asia. We see shares in Asia Pacific fell today, with Hong Kong's Hang Seng Index leading losses as Chinese chip stocks listed in the city plunged following new export rules from the U.S. The broader Hang Seng Index was 2.95% lower at 17,216 points, with the Hang Seng Index, Tech Index, down 3.98%. Also, the HSI Tech Heavy there, down 2.95%. We see the Kospi at 2,232 points. That's also down 0.22%. And the shares in Asia, in Australia there, we see that's also down about 1.40%. So we're seeing a lot of sentiment still weighing on the market from last week's job report, showing that the job market is still quite resilient, and that could make the Fed even look at raising rates even more. Markets in Japan, South Korea, Taiwan, and Malaysia close for holidays today. Let's move on now to U.S. market. We see stock futures were lower this morning as the markets come out of a tumultuous week, and traders look ahead to key reports coming in the next week that can offer insights into the health of the economy. Futures connected to the Dow Jones Industrial Average there. See it's already trending downwards there, 0.19%. And we see the S&P 500, 3,642 points. That's also down 0.30%. And we see NASDAQ, the tech-heavy NASDAQ, that's down 0.45%. Inflation will also take center stage as our new monthly consumer price index data comes out Thursday morning. We'll be looking out for that and see how the markets actually react. Let's move over to the oil market now. We see global oil prices fell today, ending 5 straight days of gains as investors look to slowing economic activity in China, the world's biggest crude importer, which revived concerns about a global recession and falling global fuel demand. Brent crude futures for December settlement fell by as much as 1.1%, was last down 77 cents or 0.8% at $97.15 a barrel. U.S. West Texas Intermediate crude for November delivery declined as much as 1.1% and was last at $92 a barrel, down about 64 cents. Services activity in China during September contracted for the first time in 4 months as COVID-19 restrictions hit demand and business confidence. According to data, the slowdown in the economy of China, the world's second largest oil consumer after the United States, adds to growing concerns about possible global recession triggered by numerous central banks raising interest rates to combat high inflation rates. And gold prices dipped for a fourth straight session today, weighed down by a stronger dollar after a healthy U.S. jobs data cemented bets that the Federal Reserve would stick to its aggressive rate hike path. And that spot gold was down about 0.8% to $1,680 per ounce at early trade after hitting its lowest since October 3rd. U.S. gold futures fell 1.2% to $1,688. The key driver today would be the U.S. dollar index, edging a shade higher. The solid U.S. jobs data last week didn't help matters, and we see the dollar index hit a more than 1 week peak, making gold more expensive for buyers holding other currencies. And Kenyan maize farmers have started growing of avocados because of the high global demand for the trendy superfood, and also exporters had cultivated international supply chains. Ibrahim Simi is one of them, who runs a business that mentors other farmers who are starting orchards there and helps market their produce abroad. Do take a listen.
Small-scale farmers in western Kenya has traditionally grown maize, but he's one of many who have reportedly switched amid soaring global demand to avocados.
Due to the look and feel.
Against the backdrop of poor sales for maize and changing weather patterns, avocados offer better prices, better yields, and can be harvested continuously for 8 months of the year.
I started harvesting about 5 weeks ago. The first harvest, I got 6,000 Kenya shillings. The second harvest, I got 11,000 Kenya shillings. This third harvest, which is today, after 8 weeks, I probably am going to get 30,000.
He's one of 5,000 farmers working with Ibrahim Simiyu, a retired electronic engineer who started a business in 2018 promoting avocados for export. Simiyu also trains farmers on how to grow quality crops.
Like many of those farmers, we also had to diversify from maize to avocado, mainly because we understood and believe that avocado has got better returns on investment in terms of cash than maize does. That's not to say maize is not important.
Kenya is now Africa's biggest producer of avocados and exports about 80,000 metric tons annually. From the farm, the produce ends up at plants like Mofarm Fresh Fruit Exporters. There, the avocados are cleaned and packaged before being shipped to markets in Europe, the Middle East, and elsewhere in Africa. Clarice Wambui is a pack house manager at Mofarm.
Our biggest market right now for the Hass avocado is in Spain, and also some quantities they go to the Netherlands. For Fuerte we do the Middle East and also Egypt. And also we have some quantities which go to Turkey.
Kenya has also ventured into the Asian market. In August this year, it became the first African country to export fresh avocados to China.
Well, I guess avocados are in hot demand right now. Well, after the break, we'll get more stories on the African continent. That's at the moment. Just stay with us. This is Business Incorporated. Welcome back. Now to our next conversation. A report by BNY Mellon Investment Management shows China, Africa's largest bilateral creditor, has been scaling back on lending in the region. Well, to discuss this and the expected impact, we have Ken Gichenga, the chief economist at Mentora Economics, join us via Zoom. Great to have you on the program.
Thank you for having me.
Yeah, so Ken, why is China scaling back on lending to this region at the moment?
Well, indeed, the many African countries are not growing at the rates that they used to. Many of them are suffering from debt distress, and the growth model that they have followed over the last 20 years has not delivered the type of growth that they had expected. So China is seeing this as a major concern and is pulling back.
And quite interesting, I know a couple of conversations going on about China's strict policy when it comes to giving out these loans. But should we be worried, at this time, because Africa still needs funding?
You're absolutely right. Africa needs funding. Many countries are still struggling with the post-COVID crisis. Many of them are feeling the inflation effects from the Russia-Ukraine crisis. So if there was a time that funding was needed, particularly that kind of cheap funding that African countries have enjoyed from China, then the time is now. But as I said, the global economic environment seems very harsh right now, and China wants to sort of manage risk from that perspective.
Well, I guess China also has to manage risk at this point. But what other options are available to Africa? What other regions should we be exploring, to get funding if this actually continues?
Well, the recent move to China, what you'd call the Facing East strategy, started about 20 years ago. And prior to that, many African countries are really dependent on the Bretton Woods institutions, IMF and the World Bank. And now it almost seems that it's sort of many countries are going back to that direction. So we are seeing the likes of Kenya and many other African countries now embracing IMF, embracing the World Bank, and almost the relationships have almost gone full circle.
And do you think Africa should be preparing right now, for a world where we might find it hard to, access international loans?
Yeah, actually, absolutely spot on, Ladi, because if you look at the bond markets right now, the African bonds have gone up by 100 basis points to about 14%. That's much higher than other emerging market bonds. So the ability to refinance in the commercial environment is becoming extremely tough. And that's why many of these countries are approaching the IMF and the World Bank. The only challenge with those concessional loans, yes, they are cheaper, but they do come with quite a number of conditions.
Yeah, quite a number of conditions that some countries are not able to spell out at this time. Well, thank you so much again, Gichenga, Chief Economist, Mentora Economics. We'll keep tracking to see how Africa maneuvers this whole issue.
Thank you for having me.
All right, now moving on to other stories. Now we see Egypt's annual urban consumer inflation rose to 15% year-on-year in September from 14.6% year-on-year in August, according to data from the country's statistics agency, that's CAPMAS. Inflation increased to 15% from 14.6%. And this was the highest since November 2018 when it hit 15.7%. The inflation rate for all of Egypt was at 15.3% in September, the same as August, according to that data. Egypt's central bank, whose monetary policy committee meets next November 3rd, targets a rate between 5 to 9%, but in June said it expected inflation to exceed the target in the fourth quarter before subsequently declining. And the German government has committed a further 6.2 billion rand to South Africa's just transition towards a greener economy and skills development. After negotiations in Pretoria, the German delegation said that it would further fund the transition over a 2-year cycle with a specific focus on climate and energy, sustainable economic developments, trading, as well as health-related and inclusivity factors. The funding will be in the form of grants and subsidized loans. South Africa is planning to shift away from a coal-resilient energy supply that falls under the National Power Utility ESCOM. In July, President Cyril Ramaphosa announced the Just Transition Framework, which under his Climate Commission sets out policy measures and undertakings by various partners to minimize the economic and social impacts of a long-term switch to renewables away from fossil fuels. And Kenya and Rwanda eyeing the West African market, with Ghana becoming the next partner for both countries under the Africa Continental Free Trade Agreement. Last week, Kenya's President William Ruto flagged off Kenya tea to Ghana. He was with AFCFTA Secretary General, and a consignment of Kenyan batteries worth $77,000 was received in Tema Port, Ghana, in a historic ceremony that marked Kenya's first export under the AFCFTA agreement. Kenya is among 6 countries selected to participate in the pilot phase of the AFCFTA initiative on guided trade. Others are Rwanda, Tanzania, Cameroon, Egypt, and Mauritius. And banks' network malfunction, among other factors, contributed to a 396.18 billion naira, or 1.9% decline in Nigeria's interbank settlement system. Let's talk about NIBS, the instant payment platform, to 32.84 trillion naira in September 2022 from 33.2 trillion reported by NIBS in August 2022. The latest data released by NIBS revealed that the total value of transactions worth 271.56 trillion naira were performed electronically in 9 months of 2022, an increase of 26% when compared to 215.76 trillion naira reported in 9 months of 2021. The NIP volume dropped to 438.17 million in September, representing a decline of 22.2% over 448.13 million recorded in August. As electronic transactions drop in September, value of checks transactions also fell by 8.52% to 265.94 billion naira from 290.69 billion in August. And that's Business Incorporated today. Thank you so much for watching. I'm Ladi Williams. Bye for now.